Most people think debt destroys wealth. For America's richest, it is the opposite. Debt protects fortunes and sidesteps taxes, saving $58 billion this year alone. This is not about loopholes, but deliberate rules private banks and billionaires quietly master. If you still believe debt is always a trap, the truth about how the wealthy actually use it changes everything. But there is a catch, and high stakes you are not hearing about. Subscribe now to see the full breakdown and the Safety First playbook. Subscribe and turn on notifications to watch the full episode and learn what to do next. The U.S. tax code draws a sharp line between money you borrowed and money you earn. When a wealthy investor takes out a loan, even for millions, that cash is not counted as income. It is a debt, something owed, not something gained. The law behind this is clear. Internal Revenue Code. Section 61 defines gross income, but loan proceeds are left out because every dollar borrowed comes with an equal obligation to pay it back. Banks treat these loans as secured by assets like stocks, real estate, or business interests. So there is real collateral and real risk if the debt is not repaid. If you want straightforward explanations, subscribe for more. But the moment those same assets are sold, everything changes. A sale is a taxable event. If you sell $10 million in stock, the IRS expects a share, typically 20% in federal capital gains tax, plus another 3.8% for high earners. That is a bill of nearly $2.4 million just for cashing out. This core distinction, borrowed money is not taxed, but sales are, creates a powerful incentive for the wealthy to use debt as their main source of liquidity. It is not a loophole. It is how the law is written, shaped by decades of court cases and IRS rulings. The Supreme Court's decision in Eisner versus McCumber set the foundation. Only realized gains, not increases in value on paper, count as income. Later cases and IRS guidance have reinforced that borrowing against assets does not trigger tax as long as the debt is genuine and secured. This is the legal bedrock that makes buy, borrow, die possible, and it is why banks and billionaires operate with confidence inside these lines. If this helped you understand the foundation, subscribe and share to help others learn how the system actually works. Private banks serve a select clientele with lending products that look nothing like a typical credit card or home equity line. If you want clearer, practical explanations about money and power, subscribe to the channel and hit the bell. These banks most often use the securities-based line of credit as their primary tool. These are revolving credit lines secured by investment portfolios, usually stocks or bonds, held at the same institution. Access is fast and flexible. A client with $10 million in blue-chip stocks can often borrow $5 to $7 million, drawing funds at will without selling a single share. The bank sets a loan-to-value ratio, usually between 50 and 70%, depending on the risk profile of the assets. A $20 million portfolio of S&P 500 stocks might unlock $12 to $14 million in immediate liquidity. Interest rates are far below what most households pay. In 2024, securities-based lines of credit at major private banks run between 3 and 5%, pegged to benchmarks like SOFR plus a small spread. Compare that to the national average credit card rate of 24%, or even a standard mortgage at 7%. For high net worth borrowers, this means debt is not a burden, but a calculated cost of access, less than the long-term return of the assets themselves. There are strings attached. If the value of the collateral drops, banks can demand immediate repayment or force the sale of securities to cover the balance. But as long as asset prices hold, these loans provide nearly frictionless cash flow. The entire system depends on trust. The bank trusts the assets, and the borrower trusts that the market will not collapse. This is debt as a privilege, not a penalty. Subscribe for more. Download the free viewer playbook to learn safe, practical steps you can take. The scale of this system is measured not just in anecdotes, but in numbers that shape the entire economy. In 2024 alone, the Joint Committee on Taxation estimates that the United States Treasury will forego $58 billion in revenue because of rules that let unrealized gains escape taxation at death. That figure is not a rounding error. It is more than the annual budget of the Environmental Protection Agency and nearly twice what the federal government spends on the National Park Service and the Smithsonian combined. The beneficiaries are not a broad cross-section of Americans. Federal Reserve data from the Survey of Consumer Finances confirms that the top 0.1% households with more than $100 million in assets hold about $8.5 trillion in unrealized gains, a sum that dwarfs the combined holdings of the bottom half of all United States households. This is not a theoretical exercise. The numbers are drawn from official sources, including the Joint Committee on Taxation annual tax expenditure reports, the White House distributional analyses, and the Federal Reserve triennial surveys. The Survey of Consumer Finances shows that wealthy families routinely use asset-backed borrowing to access cash, while their portfolios continue to grow untaxed. For these households, debt is a lever for compounding wealth, not a burden to be managed down. That $8.5 trillion in unrealized gains is not just a statistic. It represents a reservoir of untaxed wealth that can be tapped at low cost, year after year, generation after generation. These figures set the scale of what is at stake. They reveal a system that is both legal and deeply entrenched, with consequences that ripple far beyond the personal balance sheets of the ultra-wealthy. The numbers speak for themselves, laying the groundwork for the personal stories and institutional practices that follow. In 2019, Jeff Bezos borrowed $1.7 billion against his Amazon shares. He paid no income tax on that cash because it was a loan, not a sale. IRS records leaked to ProPublica revealed that this was not an isolated case. Across the country, billionaires routinely accessed hundreds of millions of dollars in liquidity without triggering a single taxable event. Their portfolios remained untouched and continued compounding in value, while borrowed funds covered everything from real estate to personal expenses. The banks were eager partners, knowing the shares backing these loans were among the most valuable in the world. The numbers are staggering, but the consequences are real. In 2008, Robert and Candace Smith, a Florida investor couple, borrowed aggressively against a $50 million real estate portfolio. Their lenders allowed them to pull cash at loan to value ratios as high as 90%. When the housing market collapsed, the value of their condos plummeted, and the banks called in their loans. The Smiths lost everything. Over $40 million in assets, multiple homes, even their marriage. Court filings show that fire sale auctions slashed property values by half, leaving debts that could not be repaid. For every story of a billionaire borrowing safely, there is a cautionary tale where leverage turned from a tool into a trap. As NYU tax law professor Victor Fleischer puts it, buy, borrow, die is the American way of tax avoidance. But even the best strategy carries risk. The advantage of asset-backed debt depends on stable markets and rising values. When those assumptions break, the fallout can be swift and unforgiving. These stories make the stakes clear. The same system that lets the wealthy sidestep taxes can also magnify their losses when the tide turns. In 2022, the Federal Reserve's rapid interest rate hikes sent shockwaves through the markets. Margin debt, which fuels much of the wealthy's borrowing power, dropped by 27%, and over $230 billion was erased in just months, according to FINRA. That was not voluntary. As stock prices fell and borrowing costs climbed, brokers issued margin calls, forcing investors to sell assets at a loss to cover their loans. This wave of liquidations hit even the most sophisticated portfolios. The lesson is blunt. Leverage multiplies gains in good times, but when rates spike and collateral shrinks, losses can come just as fast. No one is immune. Get the full viewer playbook at the link in the show notes for safety first steps you can use today. 4 rules separate smart leverage from disaster. First, never borrow at rates above 7% because expensive debt is a trap, not a tool. Second, only use debt when your investment's expected return is higher than the borrowing cost. Otherwise, you are just digging a hole. Third, keep a cash reserve or emergency fund so you are never forced to sell assets at the wrong time. Fourth, only borrow against assets with stable, proven value. The rich borrow cheap, the poor borrow expensive. That difference is everything. If you want the full Safety First playbook, subscribe now and download the guide at the end of this video. Right now, the rules let wealth grow quietly, while $58 billion in taxes go uncollected each year. As lawmakers debate reforms, the divide between asset-backed leverage and everyday debt widens. The question is simple: who truly benefits when debt becomes a tool, not a trap? Share your thoughts below.